Hi everyone, this is Angus Chen, Head of ESG Solutions of Greater China here at Alliance Advisors. Thank you for joining the webinar today. Today's topic is what are institutional investors' ESG mandates? The discussions will focus on the governance side first, and then environmental and social topics, including board diversity, director remunerations, preparation works for upcoming AGM, hot environmental and social issues raised by institutional investors, and two specific environmental topics, net zero and natural capital. Our presentations will be followed by a 10-minute Q&A sessions. As always, we'd like to hear your feedback and questions. So please send us your questions via the chat box, and we will consolidate those questions and relay them to our speakers during the Q&A sessions. We'll try to get to all of the questions, but if we do not answer yours, we'll get back to you after the webinar. We would like to introduce our distinguished guest, Mr. Jeff Jackson, Director, Asia Research, Glass Lewis. He oversees the policy research team that covers 13 Asian capital markets split across Greater China, South Asia, and Southeast Asia. Collectively, this group analyzes the corporate governance practices of over 4,500 companies annually. Welcome, Jeff. Jeff, please.
Okay, I think everyone can see my screen now. Let's see. All right, well, first and foremost, thank you for the introduction, Angus, and thank you very much, Alliance Advisors, for organizing today's webinar. As was discussed, I'm going to be speaking about institutional investors' ESG mandates and the 2022 Hong Kong AGM season. But for those of you who are unfamiliar with Glass Lewis, I thought I'd provide you with just a little bit to provide you with some background about who we are. So Glass Lewis is the world's choice for governance solutions. We enable institutional investors and publicly listed companies to make sustainable decisions based on the research and data. Our customers include the majority of the world's largest pension plans, mutual funds, and asset managers who collectively manage over 40 trillion US in assets. We have research teams located across the United States, Europe, and Asia Pacific, giving us global reach with a local perspective on important governance issues. Within the Asia Pacific region, we have offices here in Sydney, Australia, which is where I am, as well as in Tokyo, Japan. Glass Lewis covers over 30,000 shareholder meetings annually across 100 different global markets, while for the teams that I oversee, we covered over 9,000 shareholder meetings for companies traded in Greater China, Southeast and South Asia. For Hong Kong specifically, that was over 1,500 meetings last year in 2021. In terms of Glass Lewis, our offerings include our proxy paper research reports, our viewpoint proxy voting platform, as well as extensive thought leadership. You can view that on the Glass Lewis website, which includes our blog posts, our responses to public consultation papers, as well as original research. For public companies, our governance hub provides easy access and tools and resources, including Glass Lewis research and thought leadership to help companies optimize their corporate governance programs and ESG strategies. So before we get into a lot more of the ESG elements of today, I thought I'd provide at least some notable updates to Glass Lewis's policy guidelines for 2022. In particular, I'm going to be discussing topics of board gender diversity, independent director tenure, as well as some practices relating to equity-based compensation. In this current year, we've adopted a policy where we will no longer support companies if they have a single gender board. In this case, when we announced in 2021 that from 2022 we would potentially recommend against nomination committees or other similar committee chairs in the event of a single gender board, we have taken that on to basically include every single company that is in our coverage. So as we've seen thus far in this year, there are many companies who unfortunately still have a single gender board and really aren't making as many quick of strides to diversify their boards. while HKEX put in the practice that companies should cease to have a single gender board effectively from December 31st, 2024, we believe that that is too long of a period for companies to diversify their boards. In looking at some of our director data from 2021, we did find that Hong Kong companies have a disparity in terms of board gender diversity. Indeed, women as independent directors and executive directors were approximately 5% and 6% of all the directors that we covered, which was over 900 different company boards. In looking at, just generally speaking, the breakdown of women on boards, we did find, for instance, that for boards where there were no women, there was about 28% of companies, at least the 900 boards that we looked at last year, where 35.2% only had one woman on their board. So realistically, we are expecting companies to make strides in diversifying their boards. As such, we have already begun to see companies, at least this year, receive negative recommendations in terms of their nomination committee chairs, where there's been a single gender board, and there really isn't a good disclosure about how they're intending to diversify their boards in the very near future. As for independent director tenure, this is another area where we've actually adopted a new policy, which we actually informed the market in 2021. Specifically, from this year, if there's an independent director and they've served on the board for more than 12 years, we will not consider them to be independent. As has been the case for Hong Kong corporate governance practices, after 9 years, companies are supposed to provide an explanation about why directors can consider to be independent after 9 years of service. There's also the option to allow shareholders to vote on a director's independence after 9 years. But what we did see, and this is somewhat of an unfortunate element, is in Hong Kong's recent updates and changes to its corporate governance practices following a consultation paper from 2021, there was the decision to not allow for shareholder voting on a director's independence after 9 years. Unfortunately, Hong Kong chose to not follow what, in this case, Malaysia and Singapore are also doing in terms of allowing shareholder voting on a director's independence after 9 years. As such, we have basically made the policy decision that from 12 years, we will not consider a director to be independent. In this case, we again are already seeing a lot of recommendations which pertain to committing board independence for boards across Hong Kong, where there are a lot of really long-serving independent directors. As for the independent director of Hong Kong boards, we did find that of the directors who have served more than 12 years, at least based upon our data last year, approximately 31% of the independent directors had been on boards for more than 12 years, with 25% of directors being on boards for more than 12 years, with independent directors serving less than 9 years, only comprising 44% of boards. So, in all, we are expecting to make further changes or recommendations as it relates to board and committee independence due to independent director tenure. As for updates to our other proposals and policy guidelines for equity-based compensation, we have clarified our guidelines for this year to provide as to how we are going to evaluate certain types of proposals for equity-based compensations, as well as grants to individuals. Some of these clarifications include our opposition to equity grants to non-executive directors if they have performance conditions. We do note that from this year, HKEX has already indicated that independent directors will no longer allow to receive performance-based equity remuneration, but we are extending that to all non-executive directors. Likewise, plan participants should be limited to employees and directors of a company and/or its group or associated companies. We found over and over and over again that many equity-based compensation plans include customers, clients, agents, or any other person that the board may deem fit to receive equity awards. And we're wondering if this is meant to be for employees and directors, and why are there outside parties receiving these sorts of awards? Similarly, if maximum vesting period is less than 2 years, we will oppose grants and/or an equity compensation plan unless there is a preceding 2-year performance period. We find that equity-based compensation should be seen as more of a medium to a long-term form of compensation with minimum vesting period of at least 2 years, or at least there being a performance period of that similar amount. In this case, we found in many years, in many instances, that options may be already immediately vested upon their grant. So we think that, again, it is important to have more of a structured approach to how equity compensation is being provided. Lastly, plans should not have repricing provisions. Although it may not be practiced or built into plans, it should be very clear that repricing should not be permitted unless for a extreme circumstance which shareholders give their approval for. As for employee share purchase plans, we believe that discounts should not exceed 20% to the market price, seen as when you are obviously providing share issuances to other shareholders or other investors, usually the discount also does not exceed 20%. But for share purchase plans, there should also be some indications as to how employees outside the executives may participate in the plan. We've seen in other markets that share purchase plans sometimes end up going to a very small number of executives, especially if they're already major shareholders. So we think that if you're going to have a share purchase plan for your employees, then it needs to be clear as to how the employees can participate and not just the executives. We are expecting to make some further changes in the future as it relates to equity-based compensation. We do recognize that there was a consultation paper put out by HKEX toward the end of 2023 that relates to equity-based compensation practices. Once the results of the consultation are released and HKEX provides guidance as to what they may do, then we are probably going to be amending our guidelines in 2023 to reflect whatever the market ultimately decides to do. As for ESG reporting and disclosure practices, this is an area where Hong Kong has made steady progress, at least on ESG reporting. We note that ESG has been included with corporate reporting following the 2019 consultation paper, but from 2022, this year, companies are required to publish their ESG report at the same time as the annual report. We view this as being a positive development, mainly because if you have your ESG or sustainability report being released, long after your annual report, it actually may limit investors' opportunities or abilities to exercise their voting rights in assessing a company's ESG performance at an AGM. But as for the ESG reporting, obviously the ESG reports include the board progress and ESG related goals, as well as targets and their applicability to businesses, with the requirement that companies are also needing to identify risks that may materially impact businesses and or operations, along with the steps that are being taken to manage such risks. As was seen in the November 2021 guidance on climate disclosure, this is bringing Hong Kong, in its requirements and practices on ESG and climate reporting to be more in line with TCFD practices. For us, we view this as a period of time where it's going to take a couple of years for many companies to become familiar with this style of disclosure. For companies who have previously been disclosing in this manner, it may be a little bit shorter of an adjustment period, but overall we are expecting that it won't happen or companies won't be familiar with it or comfortable with it overnight, but it may take a couple of years before these sorts of disclosure practices really catch on and companies become a little more comfortable in the reporting frameworks. But in the interim, we are expecting that investors will be looking at companies with an expectation to see how they are progressing in their climate objectives. So in this case, as we've heard from other larger investors, but also speaking with companies, when you are setting your goals, there is a need to be realistic in the goals and targets you are setting. If you're going to set very lofty goals and targets and they are not achievable, then there may be some pushback from some investors as to what you are trying to seek and whether it actually is achievable at the end of the day. Similarly, issuers will need to be able to show their how their boards are maintaining awareness of ESG issues, especially E or environmental and S social risk. From this, on the governance side, we are seeing more companies adopt specific sustainability and or ESG committees. But there's also the potential need for companies to look to augment their boards to have directors with ESG related skills in order or potentially update their committee mandates. In this regard, as companies are beginning to do more on board succession planning, especially if they have many long-serving independent directors, this is an opportune time for the market and many companies to kind of readjust how a board is focusing on matters as ESG and how it really potentially impacts their business. As for Glass Lewis's views and approaches on ESG, we do view ESG as an evolving practice. As such, our views and approaches will also evolve over time. At this point, Glass Lewis does not have a policy or set of policies in 22 relating to ESG reporting or disclosure standards for Hong Kong or mainland Chinese companies. While we don't have anything specific at this point in time, we do maintain a broader global approach to ESG oversight by boards and expect boards to really manage risks that encompass ESG practices with the managing of their businesses. This may include managing risks that relate to direct environmental or social risks. So if you are in the energy industry, as an example, where are you obtaining your source of energy? If it's coal, how are you evaluating coal as in terms of your greenhouse gas emissions? Or if you are in another industry like hydrocarbons, what are you doing to ensure the safety of your infrastructure and those that may be around it? Similarly, there's the risks relating to legislation and regulation. As more markets are paying closer attention to, for instance, anti-corruption rules or the overseas practices of companies to make sure they are being good corporate citizens, what are boards doing to ensure that they're aware of what is happening both locally but also wherever they may be operating elsewhere in the world. Legal and reputational risk, again, sometimes the legislative and regulatory matters feed into legal and reputational risk, but at the same time, reputational risk can be a whole host of matters in terms of how a company responds. So there are oftentimes going to be the question of, in the event of a significant incident or an accident, what did the board know and when did they know it? So boards and their awareness, it is something that they are going to be just having to pay even closer attention to on whatever a company does. And finally, there's governance risk. Governance risk, of course, how is the board functioning? Is there good oversight of management? Is the board doing what it's is set out to do in terms of working on behalf of shareholders? Where we do observe significant failures to manage ESG related risks, we may hold members of the boards responsible for such issues. As an example, we've seen, for instance, in the palm oil industry, where companies have not had a good practice on worker rights or worker safety, and they have received export bans to, for instance, the United States. Those particular export bans have had a financial impact. And unfortunately, what's meant is that impact on shareholders is something that we look at as a serious matter. While there are many other industries which may have other types of issues, we do think that board members should be very well aware of the risks associated with whatever industry they're operating in. As for future years, we may develop more specific ESG policies, but we will allow the market time to adjust and evolve or adjust to the evolving ESG reporting requirements. As I indicated before, TCFD is something that many companies may not be as familiar with, and this is definitely their first year becoming more familiar with this approach. So in a couple of years' time, I think even for us as proxy advisors, we're also trying to get used to how companies are going about their disclosure. So I think for us, we want to see how the market really responds before we take a policy-related approach. As for Glass Lewis, in terms of 2022, we have adopted a new ESG profile page in our reports. At this point, it is covering only members of the Hang Seng Index in Hong Kong, but we have made our methodology available on the Glass Lewis website, which you can peruse at your own leisure. We have also included additional ESG ratings and supplementary ESG data in our reports through our partnerships with Sustainalytics, Arabesque, and BitSight, with the latter actually examining the cybersecurity practices of many publicly traded companies. Moving on to director pay and ESG, this is an area which I think there's going to be, in the future, greater attention being paid to. And in this particular instance, Hong Kong is not alone in the sense that executive pay is not really well disclosed by HKX listed companies, nor is it really well disclosed among many other major Asian markets. At this point in time, there is nothing similar to like Say on Pay or other shareholder proposals to vote on director or executive director pay for that matter. But while companies do disclose, generally speaking, the salaries or incentive remuneration, there's not usually much in the way of an explanation about how remuneration is being determined, or more importantly, how the remuneration aligns with company performance, especially when there's really no say in, or at least a shareholder say in, being able to vote on whether pay is considered to be, good or not in terms of practices. But we are seeing that ESG is beginning to kind of creep in amongst some companies, but not for every company. So in future years, there will be the question about, when you're looking at executive pay beyond a base salary and you have incentive or variable remuneration, how might ESG play into an executive's pay? Is it going to be part of their KPIs? But what other things may be used to include ESG as part of the determination or a determining factor of an executive pay? We've seen in other parts of the world, such as mining companies in Australia, that worker safety is oftentimes included as a metric in terms of executive director pay, and whether pay correlates with the worker safety initiatives, or might pay align with efforts to meet, for example, net zero goals. So this is something which, while it is not at the forefront for now, it is something that will probably come down the pipeline, within, perhaps the next couple of years, particularly if there is more of a effort by investors to want to get companies to do more in terms of director pay disclosure, in terms of aligning with ESG. But likewise, beyond executive pay, there's also the equity-based compensation, of which there's often a dearth of information about performance parameters. We see this as a common feature or a lack thereof in terms of equity-based plans and schemes, but when we're looking at ESG and the way a company is performing, when stock options or RSUs are being granted, is there an inclusion of ESG as performance parameters or metrics that are being considered when a company is looking at making grants to its directors or its executives? For other topical matters, first and foremost, I'm sure everyone is very much aware of what is happening in the world. I'm not going to get into the issues in terms of Russia and Ukraine, but I do want to make everyone aware that from the institutional investor perspective, there are a lot of institutional investors who are looking carefully at how companies are potentially exposed to Russia and/or Ukraine. We have seen, that there are many Chinese companies who have potentially greater exposure to Russia than others, and this is due to more existing and/or recent business opportunities. But this could be a potential risk matter. We have seen, for instance, that the Yale School of Management has developed a database which tracks companies who have stayed in or left operations in Russia. While this is the view of the Yale School of Management in terms of their tracking different businesses, for us at Glass Lewis, we are also looking at what is in that database, but also looking at annual reports, looking at news disclosures to really understand and get a better picture of if a company has operations in Russia or Ukraine, as an example. To what extent is a company exposed in those particular markets? If operations are continuing, why are they doing so? We have seen with some Hong Kong companies that a good portion of their business relates to selling of commercial goods, just everyday commercial goods in Russia, and for us, that's we understand that's part of their business. But if companies do have an exposure, what might they be doing about future operations and/or business relationships in Russia? While we are not looking to make any particular statements about Russia or anything else, we are looking for companies to provide at least an explanation on involvement or exposure to Russia and evaluate on a case-by-case basis. In this case, as I did mention earlier, institutional investors, particularly those in Western parts of the world, are paying much closer attention to what is going on. So it is in the best interest for companies to provide at least an explanation as to what is going on in terms of potential exposure there. As for preparing for your AGMs or upcoming AGMs and EGMs for that matter, since we haven't had an opportunity to engage with perhaps all the issuers on tonight's or today's webinar, we always encourage issuers to familiarize yourself with policies and proxy advisors when you're going into your general meetings. For us, Glass Lewis maintains our own policy guidelines, whether it be for Hong Kong, mainland China, or many other markets globally, which you can publicly or download straight from our publicly available website. In many instances, companies may be questioning of how proxy advisors make their recommendations. I can say pretty confidently that many times our policy guidelines can be pretty indicative of how we may ultimately recommend. But in that regard, while we have our own sets of policies, we also encourage issuers to become familiar with the policies of your major investors, especially the institutional investors, as they may have policies which are stricter than even us proxy advisors. This is especially in the case on ESG now. As I'm sure Angus will discuss in a little bit, institutional investors may have very specific policies on a whole range of governance and/or ESG matters. But we always encourage you to reach out to your investors, to engage with them, especially if they have a local or regional presence. For other international investors that don't have dedicated teams to handle their proxy voting, we encourage you to understand how your investors are actually engaged in the proxy voting, how they follow different policy guidelines, whether it be from Glass Lewis, ISS, or other types of proxy advisors. But lastly, work ahead of the disclosure requirement deadlines to really organize any shareholder engagement campaigns, but also understand object to certain proposals that can be considered at a general meeting. For your documentation in preparing for AGMs and EGMs, we definitely encourage you to know your audience. With ESG reporting in particular, there are going to be a lot of investors looking at your annual reports. Some they're going to be a little more familiar with what you do. Others are going to be less familiar with what you do. So you really want to be able to engage and educate your investors, so that way they have a clear understanding of what you're actually trying to say, whether it be from your management disclosure and analysis or ESG, or even trying to explain in a meaningful way, for instance, if a director did not attend meetings, why. We have all lived in the past couple of years where people have gotten sick over the past couple of years, whether it be COVID, for other reasons. So if a person can't attend meetings, a simple explanation actually goes a long way. As for why you're seeking shareholder approval of a proposal, we do find that companies just say, by regulation, we can do this, such as general mandates. Many companies in Hong Kong have their general mandates to issue shares, but oftentimes it's the maximum that's potentially available, and many institutional investors do not support the general mandate to issue shares at 20% of issued share capital. So really try to tell your audience, your investors, or even us proxy advisors, as to why this, why the proposal is necessary, but also what happens if it doesn't pass. We rarely really receive that as an explanation as part of the rationale. So if it's something where we're trying to decide whether to support or oppose, knowing what happens if something does not pass can be very helpful in us, making our deliberations as well. As for other areas of preparation for upcoming AGMs and EGMs, we always encourage companies to reach out to obtain proxy advisor research. Companies can obtain Glass Lewis research, which our Glass Lewis website has information how you can do that. Likewise, if you disagree with a recommendation from us, we have the ability for companies to actually comment on our research. It's called our report feedback statement. This would allow you to basically produce a statement which would go into our report. We would send it back out to our clients, some of whom are your shareholders. So that way you have a way to basically have your rebuttal to what we may have put into our reports. But last and potentially a little more important is that if you believe that there's an error in a proxy advisor's research, or there's additional information that you think proxy advisors should be aware of, it is in the best interest that you act sooner than later to contact proxy advisors. If errors are reported shortly before the holding of a general meeting, the republication of our reports may come too late for some investors in their proxy voting. Likewise, for new information such as changes to boards or anything else that is material to a company following the release of a notice of meeting, can really make a difference in our recommendation. So if there has been some sort of change following the release of an annual report or notice of meeting, it's always good to reach out so that way you can better explain what is going on, and we can always adjust our research if and necessary. As for what's next at Glass Lewis, obviously we've released our 2022 policy guidelines. We have our new partnerships in ESG and cybersecurity, that being Esg and as well as BitSite Security. We also have our governance hub, which public companies can access our research about your company or your peers with watch list alerts for immediate notification when research is published. And as I mentioned before, participating in the governance hub can also allow you as an issuer to participate in the report feedback statement, which we have seen as a very helpful tool for issuers globally. With that, I greatly appreciate, again, Alliance Advisors for putting on today's webinar, and Angus, I'll throw it back to you.
Thanks, Jack. Thanks so much for your sharing. So I think it's very insightful, and especially for those hot ESG topics. Like, for example, the linking the ESG pay remunerations. Recently, I joined several investor calls, and this is nearly the questions asking for all the corporate. Okay, anyway, so let me present my part. Okay, so I will briefly introduce what institutional investors' latest concerns on the environmental and social issues. Then I will elaborate more on two topics: net zero and natural capital. Okay. So for BlackRock, it has called out 5 engagement priorities, like whether board quality, effectiveness, incentives, climate change, and natural capital. And for climate, BlackRock encourages companies to discuss in their reporting how their business model is moving towards global net zero emissions by 2050. And companies can help investors understand their approach when they provide disclosures aligned with the TCFD, including Scope 1 and 2 emissions. And for natural capitals, investors look to companies to disclose detailed information on their approach to manage material natural capital related business risks and opportunities, including how their business models are consistent with the sustainable use and management of natural capitals and natural resources such as air and water. And it is helpful for companies with material dependency or impacts on natural habitat to disclose how they measure their progress on key issues such as water conservation, reforestation, and pollution control. This may include a discussion of efforts to improve efficiency, minimize and mitigate negative impacts, and track positive impacts. BlackRock is also interested to hear from companies how they contribute to biodiversity and ecosystem health. It mentions that the recommendations of the Task Force on Nature-related Financial Disclosure, the TNFD, will be a valuable resource for companies in their reporting. So why natural capital is so important? We can see that it contributes a lot in terms of the GDP, and natural resources are the most important input to the global economy, from raw materials and water to flood protections, biodiversity, or pollinations. Nature provides most of the capital business need to produce goods and services. The degradations of natural capital, including the loss of biodiversity and depletion of renewable stocks, poses a real risk for business, their earnings, and investors. Business, banks, and investors facing increased insurance risk, higher cost of capital, and a loss of investment opportunities. As natural capital is a complex issue and ecosystems are interconnected, therefore BlackRock focuses on 3 key areas: biodiversity, deforestation, and water, which it believes it can impact the long-term financial returns for certain companies. Generally speaking, investors would like to understand more for companies' strategies, actions, and targets. Now, for biodiversity, it refers to the various forms on Earth, including plants and animals. The economy and society remain highly dependent on ecosystems and the services they provide, such as fresh water, pollinations, and soil. And for the deforestation, commodity-driven is impacted by the deforestation and other types of unsustainable land use, are key drivers on the loss of global forests, which in turn plays a significant role in accelerating climate change and biodiversity. Also, carbon storage is one of the most critical ecosystem services forests provides. For example, like the nature-based climate solutions, a company defined as conservation, restorations, and improved land management that increase carbon storage and to avoid greenhouse gas emissions across global forests and wetlands. And the last one is about fresh water and oceans. Nearly every economic sector, and particularly pharmaceutical, power generations, food and beverage productions, is heavily dependent on fresh water. And for oceans, it generates oxygen, absorbs greenhouse gases, and determines weather patterns. For instance, extreme wind and heat stress are classified as climate risk as well. So we see the relationship between climate change and natural capital. And we see State Street also specifies its ESG priorities, like the climate change, diversity, and with improved diversity, it believes that companies are likely to drive innovations, expand their employees' candidate pool, and improve operational efficiency. And R factor is the State Street own derived assessment scheme, different from the general third-party ESG rating. And here, State Street specifies its diversity requirement. So you can see as its structure is quite similar to the TCFD about the governance, risk management, strategy, target, and metrics. So it's similar from this approach. So the next one is that we see there's some relationship between the ocean sustainability and the natural capital. And we can see that in this one, Large Van also explicit its requirement on the ocean sustainability. I would like to delineate the relationship among oceans, microplastics, and climate change a little bit more. Hope the wording is not too scientifically technical. Ocean absorbs a significant amount of all greenhouse gases produced on our planet, more than 30% of all human-produced carbon dioxide. And microplastics are small pieces of plastics. A growing volume of microplastics is found in the environment, including the sea and in food and drinking water. Once in the environment, microplastics do not biodegrade and tend to accumulate, posing threats to human health. And microscopic plants and animals capture carbon on the ocean surface and transport it into the deep oceans, preventing it from re-entering the atmosphere. Due to the presence of the microplastics, some of these microscopic plants and animals could not well function, reducing their ability to absorb carbon. This demonstrates the interconnectedness between climate change and natural capital. Okay. Going next, I would like to elaborate a bit more about how a company to prepare for the net zero and natural capital. Okay, so we hear the net zero term so much. So what is it exactly? According to the Science-Based Target Initiatives, basically setting the net zero is about a net zero target aligned with meeting climate goals. Means the first one is achieving scale of value chain, the upstream and downstream emissions are consistent with the 1.5 degrees Celsius halfway. And all of us know that we can't reduce the carbon emissions to zero. That's why we need to neutralize the impact of any residual emissions by permanently removing an equivalent carbon dioxide. I think for this permanently is very important because nowadays there's a different carbon absorption technologies, but whether these technologies can keep or store the carbon dioxide permanently, maybe for over 100 years, that is another question. Okay, to start and prepare for the net zero for companies other than the NGO and financial institutions, there's a few questions. The first one is the company a parent company or subsidiaries? Especially for some conglomerates, they include a number of subsidiaries across different business sectors. And SBTi would conduct review on the scoping for your submissions. That means when you submit your submission to the SBTi for validations, they will check your scoping, particularly whether some of the subsidiaries are intentionally excluded. Also, has the company already set a near-term science-based target? And has the company complete a full GHG inventory, including the scope 1, 2, and 3? For the scope 3 emissions, I will talk more in the next slide. Okay. So I would invite all of you to see these questions. We all know that scope 3 emissions are generally greater than the total of scope 1 and scope 2. How many times are scope 3 emissions greater than scope 1 and 2? So feel free to type your answer in the chat box and see what's the outcome. Okay, it seems that maybe there's some technical issue, but anyway, let me tell you the answer. The answer is nearly 4 times. So we can see that Scope 3 emissions contribute a lot on this. Yes, as mentioned, the Scope 3 emissions often make up the largest portion of a company's carbon footprint. And if your company would like to submit to the Scope 3 emissions, you need to set the near-term target and the long-term target. And for the near-term target, you see that it's necessary to set one or more emission reduction targets, at least 67% of the total Scope 3 emissions. So the question is, why do you know there are total emissions? That means you need to build up the inventory and do some tracking as this. And for the long-term target, like the net zero for the 2050, definitely it's more challenging, and it shows the exclusion as well. And according to the GHG protocol, there's 15 categories covering the upstream and downstreams. And I think for most of the companies, purchasing goods and service is one of the generally key contribution, because you may need to purchase some raw materials or need to purchase some office equipment. And you may not be able to get the carbon footprint of that computer or printer, then you may need to do some estimations. At the very beginning, it's all right. Yeah, it's fine that you can do some estimations, but later on, you need to get the primary data on this. And we can see that there are 15 categories. And meanwhile, I found that some of the Hong Kong companies may report their Scope 3 emissions in a different rate. So please pay attention to this point. And after building up the inventories, there are still a few more steps. So the first one I suggest definitely is the internal engagement. As I have worked in the one real estate in-house ESG team before, I really can feel the importance of engaging internal departments. For example, what are their priorities, or do they know what's the carbon emissions, and especially how to liaise with the external suppliers. Generally speaking, the in-house ESG team will not contact the external suppliers directly. They may need to work with the procurement department and so on. And as I mentioned, neutralizing the residual emissions is very important, and how to leverage renewable energy is critical. For renewable energy, apart from on-site renewable energy generations, there are several more options for renewable energy procurement. For example, direct procurement from off-site grid connect generators, such as the power purchase agreement, green electricity products from an energy supplier. So when selecting the suitable approach, how to avoid double counting is one of the key considerations. And also we see that the renewable energy market is keep on changing. That's why keep monitoring the renewable energy market is important as well. And for the target setting, it is suggested to set up an aside target internally. What are the targets for the in-scope departments and the business units? And for the external communications, what's the external targets? And what are the internal targets? These should be pay attention as well. Hey, for the lateral capital, the TNFD, so not the TCFD, is a market lead science-based organizations. it would like to develop a risk management and disclosure framework on this, and add on some how to support a shift in global financial flows away from nature negative outcomes and towards the nature positive outcomes. And for the TNFD framework, it provides some basic understanding and the disclosure recommendations. And here's some key definitions we need to know. For example, what's the nature? It covers the 4 key areas. And what are the natural capitals? And how do the companies check or assess their dependencies and impact? And I would like to take a high-level overview of the LEAP approach. I think this is a good starting point for companies to do some nature-related risk and opportunity assessment. It is similar to the general risk management approach that how to identify, evaluate, prioritize, and respond to risks and opportunities. For example, people are concerning the air quality more. It is a business opportunities. For example, a commercial building property management might enhance its ventilation system to attract more tenants. So it is recommended to do some desktop research first. And at this moment, maybe not necessary to handle tasks like quantify the natural risk. And here are some suggestions to companies, and suggest to engage with the institutional investor and outreach to them more to understand what are their expectations and timeline. And in the meantime, companies can express their view on the ESG and why they choose and why they identify these are the ESG priorities. So it is highly recommended to build a robust materiality assessments so that you can explain why these are the priorities and why some of them are not, so that you can refine your ESG strategy. And finally, I would like to briefly introduce Alliance Advisor. The Alliance Advisor has established for US for nearly 70 years. We provide sophisticated, data-driven strategic advice to corporate clients and their advisors. We are the single source solutions for corporate executive, law firm, and investor relations agency for all policy solicitation, corporate governance, investor intelligence, and ESG matters. We provide a year-round support by leveraging our expertise in investor intelligence and shareholder identifications, and our close relationship with institutional investors. We identify corporate companies' top institutional investors and understand their concerns. As such, we help companies to accomplish various ESG tasks strategically and efficiently. And under our ESG advisory service, we provide ESG investor engagement, ESG reporting, and third-party ESG rating solutions for like the MSCI ESG, Sustainalytics, CDP. We also provide shareholder identifications and policy solicitations as well. And finally, we also are the members of the SASB and the TCFD and the TNFD forum member as well. So that's for my presentation. And so we would like to have a Q&A sessions right now. So if you have any questions, feel free to let us know. You can type into the chat box so that we can know more on this. Okay, maybe meanwhile, I have a questions for Jeff. Jeff, so about for the ESG pay link, I think several investors are asking more details on this one. So what do you think about what the companies can prepare, or anything they can disclose a little bit more?
I think when it comes to overall ESG disclosure, I think it's having a strong sense of or a strong set of metrics. Obviously, it's going to vary industry by industry, but I think if you can have clear metrics about your industry, what are the material risks, if it's an intensive industry in terms of greenhouse gas emissions, what are your scope 1, 2, and 3 emissions? Obviously what you're doing about it, and as well as just again your general approach to, for instance, company diversity, board diversity. I think it's it's being very clear about what is the current state of certain ESG practices, and what are the goals that you're trying to reach and how you're going to get there. I think that will be underlying the main foundation of kind of how companies should really look at their disclosure over the next couple of years. So yeah, I'd say as companies get more comfortable with TCFD, then it's going to be getting into the more finer details of their disclosures.
Thanks, Jack. Definitely, I think that how to have a clear mechanism, and at least internally, it would easier to elaborate the ESG pay link issue. Yeah. So if there's any questions, please feel free to let us know. Is there one question? Okay, I see these questions. I think it is more on the ESG related. So how can financial institutions to achieve carbon neutralizations from investment aspect? As sometimes we cannot direct monitor or educate those indirect or co-investment projects. Yes, definitely. When you see my presentations about the net zero, you can see that I say that the companies other than the NGO and financial institutions, because for the science-based target, there's another guideline specifically for the financial institutions. But I can say that maybe more stick to the point. I think how to drive the neutralization is that for the scope C, because for scope 1 and scope 2, the financial institutions could control it, right? But for the scope 3, we all understand that it is not so straightforward. But apart from encouraging the those upstream or downstream value partners or stakeholders to reduce their emissions, you may consider whether they will leverage the renewable energy. For example, procure the renewable energy certificate. One of the critical points is that your downstream or your investees companies scope 1 and scope 2 is the investor scope 3. So I repeat. So if you have a investee companies, it's in your scope 3, but you need to ask them to reduce them. So reduce that scope 1, 2, so that your scope 3 will be reduced. So this is the situation. And one more is that how to engage them. And I can mimic some supply chain practices that some of the company will hold them the supplier engagement meeting annually, or even they set up a clear data collection template or requirements so that they could influence their suppliers. So I hope it will be useful. Thanks so much. So that's another question.
It looks like I'll take this next one. So the question is, recently, independent directors are taking a leading role in engagement with shareholders. How is Glass Lewis approaching independent directors in the engagement before AGMs? Yeah, it is a good question. We have been working to try to increase our engagements with companies, whether they be in Hong Kong, mainland China, Taiwan, India, Singapore, just globally. We do encourage companies to engage with us. We try to accommodate engagements on try to be on an almost year-round basis. Obviously, during the peak of AGM season, it may be a little more challenging for us to meet with every company just because our workload is just a little bit higher. That being said, we do have policies in terms of our engagements where we are happy to meet with companies, leading up to AGM seasons, especially as companies are working to finalize their resolutions, and we are happy to have engagement meetings which are basically off the record, where we can discuss whether it be just general corporate governance topics. If you wish to give us an update about the company, anything that is said during the course of those engagement calls is off the record and can't go into our research, as our research is based strictly upon publicly available information. So, if you wish to engage with us, by all means, all you have to do is go to the Glass Lewis website and request an engagement call. We typically don't engage with companies once a meeting notice has been put out and the company enters into the solicitation period. We prefer not to engage during that period of time for, to avoid any particular, matters that may otherwise arise. But outside those times, we are, very happy to engage, especially, outside of the AGM seasons. But leading up to the AGM season, depending on whenever a company may be having this AGM, by all means, feel free to reach out and we'll do our best to accommodate your requests for an engagement call.
Okay, thanks, Jack. Okay, so thanks so much for several questions. So I think there's still 2 questions, and apart from this, I think maybe one more questions, and then we may need to adjourn this webinar. So I just simply repeat this question first. Would there be a double counting? My scope 3 would well be someone else's scope 1, 2. For this viewpoint, from the company viewpoint, there's no double counting. But from the the whole emissions of the world, yeah, it is part of B. So if strictly speaking, some of the guidelines has mentioned that if you report the scope 3, you are suggested to disclose and contact those suppliers that you are disclosing these supplier emissions. But I think at this moment, it may really take some time to do so. I think the first step is at least to build up the scope 3 inventory first. But anyway, if there's any other more specific discussions, he or she could reach out to me. Yeah, I'm welcome. And for the last question, let me repeat that question, is that are you able to share any GL policy guideline insights from an Australian perspective, and also in the ESG fund? Okay, so maybe Jeff, do you have any idea on this?
I mean, from an Australian perspective, I don't know if the person who provided the question is an Australian investor or not, or if you are asking more about our Australian policy guidelines. If it's the latter, then in the policy guidelines for Australia, we do have a discussion about board oversight of ESG matters. Obviously, that's been a little more of a hotter topic in the past couple of years due to some particular incidents, with mining companies or other financial and regulatory matters. But I do believe, at least from an ESG front, we do maintain also some overarching global perspectives and some thematic policies on climate change, as well as other types of proposals. Now, one thing that we, I'll just say this kind of quickly, is Asia is a little bit different, especially Hong Kong and many other Asian markets where there isn't as much on proposals that originate from shareholders on say on climate change as we've seen elsewhere in the world. So while we do have a more global approach on matters like say on climate change, those aren't as applicable in many of the Asian markets simply because there isn't as much of the shareholder activism to really put forward those shareholder proposals. That being said, you can take a look at the Glasshouse website and our policy guidelines sections to look at policy guidelines, whether it be for Hong Kong, Australia, mainland China, India, United States, various European markets, etc. I hope that answers the question.
Okay, thanks so much, Jeff. I think about for the ESG and for the Hong Kong market is about the Hong Kong ESG reporting guideline. And I think overall speaking, the global reporting guidelines is also updating. And because I see that the last question is, the last question is, what's the international trend requiring audit on ESG report? So for the report, I can say some mentioned as third-party verifications. So there's two levels. The first one is the limited assurance, and the second one is the reasonable assurance. So in Hong Kong, most of the companies, if they do the assurance, they will do the limited level. Because for the reasonable assurance, it is I can say the standard is much higher. Yeah. And what's the international trend? So I think to Will's point, the first one is that if you have been aware about the SEC, the US, the climate proposal, there's some statements about whether to put the limited assurance and reasonable assurance in later time, maybe after 2025. And in Hong Kong, there's still no very specific recommendations. But during the consultation conclusion from the Hong Kong Exchange, it recommends and suggests companies to do the assurance. So I think this is the situation. And I will suggest company to do some limited assurance first, even they do not necessarily publish the statement, because if the company hasn't done anything or being reviewed or audited by this, and then later on they need to do so, then there's some difficulties. Especially you may need to get some more supporting documents from other departments. So it's better to start first on this one. Okay. So thanks so much for all of us. And maybe if there's still some questions, so you can see that there's some email address. So feel free to reach out to us. And I would like to let you know that the replay of this webinar will be available on our website, www.allianceadvisors.com. And thanks, Jeff, again for his insightful sharing today. And thank you so much for listening to this webinar. The webinar is now adjourned. Thank you, and have a nice evening.
Thank you.
Thanks so much. Bye-bye.